This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, November the 25th, 2015. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates global risk. Therefore, the slides this morning will focus on our other three report areas of the GMTP report, the macro, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion on what I see to be the turn in the global credit cycle. In this regard, I'd like to discuss specifically the following areas: global and U.S. demand and industrial production and trade, what it's resulting in terms of corporate cash flows, profit, earnings, and margins level, and then into the credit cycle itself as we see changing consumer credit from the U.S., and end with unusual patterns that I think reinforce my observations. In March, I began writing about what I was seeing with quantitative easing being a failed experiment, and specifically, I started writing about how quantitative easing was becoming more about oversupply than of its intended purpose of creating economic demand. Cheap money may help consumers' ability to consume, but it was having a much more profound impact in my mind on suppliers. It turns out that the expected wealth effect for consumers paled in comparison to allowing producers to ramp up production and in turn for their suppliers to meet these rising abilities. At some point, it can be expected the demand and supply will come into balance. That balance can be preceded by a massive overshoot of supply if money is made too cheap for too long a period of time. And this is what has occurred. Too many suppliers chasing slowing demand growth leads to lost pricing power. Margin and profit problems can be hidden with easy credit. Zombie companies can be kept alive, and they in turn bring further pricing power pressures. This is the stage we are in now, and I have also written about this. What we are going to discuss here today, though, is we have entered another stage in this rebalancing. Specifically, we have a turn in the credit cycle as cash flows shrink and the requisite credit ratings for existing and new loans are under pressure. In previous reports, I additionally laid out that easy credit, quantitative easing, and ZIRP brought demand forward. Quantitative easing is no longer bringing demand forward, and in fact is now working against this by reducing this pricing power that I've mentioned and unleashing powerful global deflationary pressures as a consequence. Whether you call it the moral hazard cycle due to monetary malpractice, the policy responses of central banks and stimulus leads to over-financialization of the economy. This effectively becomes a bleed on productive capital and leads to slowing growth. This is perfectly predictable. It's how the capitalist system works. Instead of a healthy economic recovery, we experience elevated asset levels, overvaluation, and growing income disparity if we maintain these kinds of policy without allowing the economy to clear itself and reset and remove malinvestment. The cycle shown here begins and ends with demand. Domestic demand leads to increased domestic imports. This in turn leads to increased international trade and industrial production. This in turn increases commodity prices and the activity of commodity-based economies globally. This is what we have witnessed, as I will show, but we need to understand the signals we can expect when this demand-supply balance is met or, in fact, is overshot. Let's start where the demand was historically initiated from, the U.S. consumer. The U.S. is a 70% consumption economy, and the spending habits of Americans have been the economic puzzle for decades. The question was only about how long it could possibly go on and what would stop it. The 2007 crisis stemming from residential housing gave us our first taste, but a steadily collapsing middle class and more than a decade of slow wage growth has finally impaired U.S. consumer demand growth. These factors, along with significantly falling energy import costs, have curtailed the flow of funds from the U.S. into the global supply chain, something called the Triffin paradox, which I've talked about in macroanalytics. The change can best be visualized as a global supply chain shock. Cheap money during the financial crisis initially had a major impact on stimulating demand by bringing future demand forward. This is shown here in green. However, in two waves since, this demand has plummeted down and is shown at point A and B. We will see this wave at its turns as we progress through the supply chain shock. We see an exact correlation when we look at world trade versus U.S. imports. There is an unmistakable correlation, but to be fair, not necessarily causation. You can see a slightly different profile, but with the same turn dates when we look at actual levels versus percentage changes. The profile reflects a steady decline from the initial demand shock increase with a clear acceleration after the last turn date. Clearly, world trade is breaking down, and it is interesting to note that it is at exactly the point the long-term support trend line shown here would indicate that a critical test was at hand, and you can see that it broke down from that point. Technicians would tell us we have a new trend and it is down. Let us shift our global supply chain examination to actual industrial production from which global trade is produced. It has clearly leveled off and appears to be turning down for only the third time in 20 years. If we add some trend lines, we see the impact of the two financial market crises we've experienced since the dot-com implosion. It also shows the degree of slowdown since the last financial crisis. Looking at world industrial production on an annualized change basis, we see a steady and clear decline. Going back to our trend lines, but looking at U.S. industrial production only, we see something quite interesting. Notice that the U.S. reached its peak in 2014 and has clearly turned down since. The slope is much flatter, reflecting the reduced rate of industrialization of America, or maybe even, I would argue, deindustrialization of America. This tells us something about job growth, high-paying industrial jobs, and middle-class consumption. We don't normally talk markets and earnings in our GMTP report and defer those discussions instead to our MATA reports. But the preceding charts of slowing in global industrial production is showing in slowing top-line revenue growth and more recently in earnings. S&P earnings are now contracting. S&P 500 profit margins have turned down. Historically, this often precedes economic recessions. The chart on the right shows how serious this is for small business operating margins. Of course, none of this is laid out for you on CNBC, which depends on advertiser revenues, who in turn is held ransom by U.S. consumption. This is simply a story that must be relegated to the back pages for fear of people seeing what is actually going on. If it gets worse, though, if we continue to follow the money. So if top-line revenue growth, margins, and earnings are all falling, what about cash flow? There isn't much room to cut staff and freeze salaries and benefits. That has been relentless for over a decade now. Net debt to EBITDA is 2 times higher than in 2006, while the percentage of companies with net cash is the lowest since 2006. U.S. corporate debt has exploded and massively exceeds EBITDA. What does this mean? It means credit rating downgrades are ahead. It means a reversal in the credit cycle. Before we talk more about credit cycle reversal, let's revisit the American consumer for a moment, the historic driver of demand. U.S. revolving credit has significantly diverged from U.S. exports. Divergences are often major warning signals. What is this telling us? If you look at revolving consumer credit on a monthly flows basis, it suggests the U.S. consumer is tapped out and has started to resort to using their credit card to support their basic monthly needs. It is definitely not being spent at retail stores, as everyone is reporting major concerns and worries about the upcoming holiday season. Credit is growing in only a few areas, and in those areas at some substantial rates since the financial crisis. Where is that and why? Well, you can see it is in car loans. Americans are using credit to buy cars they need to get to work or to search for jobs. But who is extending them this credit? Are you sitting down? Well, it's you. You are, the taxpayer. The U.S. government, according to the latest reports, is the owner of over $1 trillion in auto loans. This nearly matches the entire growth in U.S. auto loans. Between auto loans and student loans, the U.S. government is the primary supplier of U.S. credit today, not the banks. They aren't lending, and if they are selling the loans very quickly. Remember Government Motors or GM? Well, GMAC was turned into Ally Financial, which is the largest producer of ABS auto loans. The U.S. government may no longer have a stake in Government Motors, but guess who is still buying all that Ally ABS paper? Wonder why lease rates for cars are so low? Well, the 3-year lease residuals allow that. Guess who owns the overinflated residuals? Right, the owners of the asset-backed security papers. That's what the $1 trillion in U.S. government auto loans is. Call this Fannie Mae too, only this time you also have Sallie Mae for all that student loan debt by students living in their parents' basements, looking for jobs, and taking non-paying intern positions. Somebody's going to have to come up with the default payments. And who owns that paper? The government. So the government is the only one right now in the United States extending credit and allowing the consumption to even maintain the current rate. But for how long? Retail sales are becoming such a problem that channel stuffing is now standard practice. This is not something we haven't seen many times before and is standard practice. Seldom has this situation not preceded a recession. A recession that the central banks would try and stop with rates already at zero? This would be a first. The simple truth is excess debt and leverage is weighing on consumption. Money velocity continues to fall. They wouldn't dare show this on CNBS. When situations get this tenuous, we can expect any disruption or black swan event to trigger a major problem. We have plenty of potential black swans to watch. I'll leave these for another discussion. I've shown this chart previously when we began talking taper. In the globalization trap thesis, I argued the emerging markets, who are the primary suppliers of commodity products, would be hard-pressed when the inevitable echo boom arrived. That has occurred and continues to occur as we talk. The Baltic Dry Shipping Index is now at levels we haven't seen before, not even during the 2008 financial crisis. Trade, production, and commodities are not shipping. Even the Port of LA is seeing falling volumes, as is U.S. rail traffic. The story is consistent everywhere you look, if you have the heart to actually look. I'm not saying we are going to have a global recession, but the data is strongly suggesting that this is a real possibility. Minimally, we can expect it to impact the data-driven Fed in 2016. The following model, shown here, looks at a composite of leading indicators for 35 countries. Indicators such as money supply, yield curve, building permits, consumer and business sentiment, share prices, and manufacturing production. It then uses a logistics regression method incorporating the composite of leading indicators and trend data for all 35 countries. The objective is to predict the likelihood of a global recession. A score above 70 indicates a high recession risk, and below 30 signals low recession risk. The box at the bottom center of the chart shows the model versus actual recession, and I'm sorry it's not as clear as I'd like. Note that global recession has occurred 85.4% of the time when the model reading has been above 70. It is at 86.1% today. Let's turn to what we need to focus on. All this means is that the credit cycle can be expected to, and in fact is turning. It is perfectly normal even if we can't accept the reality of it. My experience has been that shrinking free cash flows triggers this as credit ratings are then reduced. Whether officially or unofficially, credit gets more expensive and more difficult to get. We're clearly seeing that in high-yield bonds today. Forced deleveraging, as we've discussed last month with Glencore, are to be expected going forward, and probably in a very accelerated and significant manner. The consumer simply can't afford asset purchases or carrying costs when net worth as a percentage of disposable income reaches these levels. It isn't magic, it's just simple mathematics. Yes, it can go on longer. Yes, the central banks can increase balance sheets and force more liquidity into the system. But there is insufficient new unencumbered collateral to support new debt growth. Additionally, we have existing loans going bad and their ability to be rolled over with cheap money. This is not only in developed nations, but across the globe where excess supply has been built based on false demand. There are many classic signs of turning credit cycle, which I lay out in November's MATA document, which I don't have space to lay out here. Something I would like to point out in closing is the number of disturbing anomalies we are witnessing in the financial markets. Not only is the credit cycle turning, but something is terribly broken somewhere in that credit cycle and credit market. I would only be speculating at this point, but custodial and counterparty risk fears are something you should pay a lot of attention to. 6 of the strange things that we're seeing are negative swap spreads, fractured repo rates, corporate bond inventories below zero, systemic credit trading higher than cash credit, sigma market moves that aren't supposed to happen, just keep happening, and volatility itself is more volatile. I believe we are entering the final sector in the roadmap we laid out in the globalization trap. Collateral impairment, real deflation, real wealth destruction, and a potential crack-up boom based on central bank reactions to the mounting and possibly insurmountable looming credit problems. We have too many people on the wrong side of the boat believing in central bank omnipotence. Nothing good ever comes from everyone believing the same thing, specifically in the financial markets. Remember, the answer will be from the authorities to print more money. No matter what the problem, the answer is always more money. It is the only answer politicians can agree on, because there are winners when money is printed. So until no one wants it or trusts it, it'll happen and continue. And that eventually will lead to some level of a fiat currency crisis or resetting or rebalancing. In closing, I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing, however. You must remember, though, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading, do your research, and make sure you have a very knowledgeable and well-informed financial advisor. So until we talk again, may 2015 and 16 turn out to be outstanding investment years for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.